All right, let's talk about investing. For a lot of us, it can feel like this huge, impossibly complicated puzzle, right? Well, if you've ever felt that way, you are in exactly the right place. We're going to break it all down step by step into a really practical guide to help you build wealth with, and this is the key part, confidence. So let's get into it.
Have you ever looked at the world of finance and just thought, this is a game, and I don't know the rules? You see all the crazy charts and you hear the jargon, and it's so easy to just feel like it's not for you. Well, if that sounds familiar, I want you to know you're not alone. That feeling is completely normal. And today, we're going to figure out exactly where that feeling comes from, and more importantly, what we can do about it.
So, first things first, why does this all feel so hard? It turns out the biggest obstacle isn't the market, it isn't the economy, it's us. It's our own brain. When it comes to making smart decisions with our money, our own psychology is often our worst enemy. And look, these aren't personal flaws. This is just how we're built. Our brains evolved for survival, right? To find food today, not to figure out a 30-year retirement plan. So of course we want rewards now. We react impulsively when things look scary. And yeah, we tend to be a little overconfident. We also fall for things like the gambler's fallacy. That's the feeling that if a coin lands on heads 5 times in a row, it's gotta be tails next. Our brain craves patterns, even when there aren't any. This wiring, which was great for our ancestors on the savannah, makes us kind of terrible at the patient, logical game of long-term investing.
And while our brains are playing all these tricks on us, there's this silent killer at work: inflation. Every single day, the money you have sitting in a savings account is losing a tiny bit of its power. It buys less and less over time. It's like a hidden tax that just eats away at your savings. And that's exactly why doing nothing is actually a losing strategy. We have to put our money to work. So, how do we fight our own instincts and beat this slow creep of inflation? Well, we do it by understanding 2 fundamental rules. Think of these as the laws of financial gravity. They aren't opinions, they aren't tips, they're just how the system works. And here's the first and most important law of all. Risk and reward are 2 sides of the same coin. It's simple. If you want the chance to earn higher returns, you must be willing to accept more risk. There's just no such thing as a high-return, totally safe investment. It doesn't exist. So the goal isn't to avoid risk, it's to understand which risks are worth taking.
And that leads us to this really important idea, the risk premium. Think of it like this. It's the bonus the market pays you for being brave. It's the extra potential return you get for putting your money into something uncertain, like stocks, instead of something super safe, like a government bond. It's the market's way of saying, hey, thanks for taking on this uncertainty for us. Here's your potential reward.
The second golden rule, you've probably heard of it. It's the magic of compounding. This is where your money starts making money, and then that money starts making its own money. It's like a snowball rolling downhill. It starts small, but over time it gets bigger and bigger, faster and faster. The big takeaway here is that your most powerful investing tool isn't a stock tip. It's time. The money you invest today is way, way more powerful than money you invest 10 years from now.
Okay, so we get it. We get paid to take on risk. But, and this is a really crucial detail that most people totally miss, not all risks are the same. In fact, the market only rewards you for taking on one specific type of risk. And the main way we manage all this is through diversification. You know the old saying, right? Don't put all your eggs in one basket. That is literally all this is. By spreading your money out, you protect yourself if any single investment goes south. It's called the only free lunch in investing because it lets you lower your risk without lowering your expected returns. You should always, always take the free lunch. And this slide right here breaks it down perfectly. On one side, you've got specific risk. This is the risk that a single company, say Tesla, has a really bad year or even goes bankrupt. Because you can get rid of that risk for free, just by owning other companies too, the market gives you 0 extra reward for taking it on. Betting it all on one stock is a gamble you don't get paid for. But on the other side, you have systematic risk. This is the big stuff: a global recession, a war, a pandemic. It's the risk that affects the entire market. You can't diversify this away. And this is the risk the market pays you that risk premium to put up with. Let that one sink in for a second, because it's everything. The market only pays you for the risks you can't get rid of. So your job as an investor isn't to be a daredevil, it's to be smart. You want to eliminate all that unrewarded specific risk by diversifying, and then get paid for holding on through the market-wide systematic risk that's left. Okay, so the strategy is clear. Diversify like crazy, eliminate that specific risk, and just capture the market's return.
But how do you actually do that in the real world? This brings us from the why to the how, to the smartest tools for the job. Now, you might think the answer is to find some brilliant Wall Street genius to pick stocks for you. Well, take a look at this number. It's kind of staggering. Over the last 10 years, more than 97% of professional fund managers in Europe failed to beat a simple market average. Let me say that again. Almost all of the pros fail to beat the average. Trying to beat the market is statistically a loser's game. And here's a big reason why it's so incredibly hard. Research has shown that over the last 3 decades, just a tiny handful of superstar companies, less than 2.5% of them, were responsible for all of the stock market's gains. So if you don't own those few massive winners, you're pretty much guaranteed to lag behind. The odds of picking them in advance? Almost zero. So if trying to find that needle in the haystack is a terrible idea, what do? It's simple. You buy the whole haystack. And that's where exchange-traded funds, or ETFs, come in. An ETF is basically a basket that holds hundreds or even thousands of different stocks or bonds. With one click, you can buy a tiny piece of the entire market. And the benefits are just huge. You buy one ETF and poof, you get instant diversification. The costs are unbelievably low. We're talking a tiny fraction of what old-school funds charge. They're super easy to buy and sell, just like a stock, and many of them are accumulating, which is a fancy way of saying they automatically reinvest the dividends for you, which just turbocharges that compounding we talked about. They make a really sophisticated strategy really, really simple. Okay, theory's over, we know the rules of the game, we've got our tools, so what does this look like when the rubber meets the road? Let's talk about building a simple, effective, real-world portfolio. Here are 2 great examples of what are called lazy portfolios. They're designed to be set up and then pretty much left alone. On the left, you've got the classic 60-40 portfolio. 60% in stocks for growth, 40% in bonds for safety. Can't go wrong. On the right is a slightly more complex one called the golden butterfly. See how it splits things up even more? You've got different types of stocks, different types of bonds, and even gold. The idea here is that no matter what the economy is doing, growing, shrinking, inflating, something in your portfolio should be doing well. And this chart shows you how it all plays out. You can see the portfolios grow pretty steadily over time, even through some really rough patches like the 2008 crash. Now look at that table at the bottom. See that column called Sharpe ratio? Don't worry about the math. All it means is how much return did you get for the amount of drama you had to put up with. A higher number is better, meaning a smoother ride. The point isn't just to make the most money in the good years. It's to build something that's resilient and protects you in the bad years too. Now, there's one specific economic situation that can be really tough for a simple stock and bond portfolio. It's called stagflation. That's when you have high inflation, but the economy isn't really growing. In those times, both stocks and bonds can fall at the same time. It's a tricky spot. And that's exactly why some of these more resilient portfolios add a third pillar, like gold, which historically has done a decent job of holding its value when everything else is struggling. So let's wrap this all up. It really just comes down to a few simple rules for success. 1, invest consistently. Put it on autopilot if you can and just ignore the day-to-day noise. 2, once a year or so, rebalance your portfolio to get it back to your target. 3, think long-term. Don't judge an investment based on how it did last month. Judge it based on the job it's supposed to be doing in your portfolio. And 4, and this is the hardest and most important rule of all, stay the course. Don't panic, don't change your plan when things get scary. And that's it. We've pulled back the curtain on the psychology, we've learned the fundamental rules, and we've found the best tools for the job. You now have a complete framework for investing without all the doubt and confusion. Building wealth isn't about secrets or crazy gambles, it's about discipline, diversification, and time. So now that you know the rules and you have the tools, the only question left is, what's your first move going to be?